May 2025 bond auction is out for your bidding. Our today's video, we are not just looking at the features of the bonds that are floated for this auction or their important date alone. I want us to look at the importance of a bond investment and where you should buy your bonds. Should you buy your bond from the central bank, that is the government agency that is issuing the bonds, or you should go and purchase your bond from the stock exchange? To begin with, we will look at 5 out of the many reasons why a bond investment is a good investment. And reason number 1 is the type of income that you get from a bond. The main income we are referring to here is the coupons. And the nature of that income, it's a fixed income. And that is the main reason why the bonds are called fixed income securities. The coupons that you are paid from a bond investments do not change for the entire maturity period of that bond. The maturity period is what we other times call the bond horizon. We also call it the bond tenure. We also call it the life of a bond. The coupon rate does not change, regardless of the changes in the marketplace, the changes in demand and supply, the changes in market interest rates do not affect the return that you get from a bond investment. Importance number 2, originating from the first one, that is the fixed return or fixed income, is objectivity and predictability of that income. The coupon rate is known and fixed, and because of that, then the incomes are predictable. And in fact, the specific dates when your coupons from your bond investment shall be paid to your settlement account are known in advance. And therefore, for that reason, it makes it possible, objective for your planning. Make it possible, objective for your planning purposes. You can match your future goals with the coupon payment dates and the redemptions, because all those are parameters that are known to you before you invest in a bond. Number 3, bonds are real assets. Bonds are assets of the nature of a financial asset. They can also be referred to as cash generating assets, and that will apply mostly when you are talking of personal finance coaching, because that is an area that only considers cash generating assets as assets. Any other asset that could be taking money out of your pocket, it's mainly regarded as a liability. Bonds have real values and intrinsic values. And as such, with those values, then a bond as a real asset can also be traded. And that gives us our importance number 4. Through the trading of a bond, and we have a specific market where these instruments exchange hands, and that is a secondary market, normally the stock markets. In our local market, we call it the Nairobi Stock Exchange. In trading of a bond, you are getting capital gains. The trading is a process of liquidation or changing your bond as an asset back. You are converting it back to cash, either for your utilization or mainly to take up other investments and take advantage of the increased value. While in importance number 1 of the fixed income, we have indicated that the rate of return or the coupons that you're supposed to be getting from your bond does not change. It remains constant. It's fixed throughout the life of that bond. The changes in the marketplace do affect the value of the bond when you are trading it in the stock exchange. If you are holding a bond or at a coupon rate which is higher than the prevailing market yields and prevailing market interest rates, then the value of that bond goes up. When the value increases and you choose to dispose that instrument, then you'll make a capital gain because you'll get more money than what you invested, and that is excluding the accrued interest on a bond as to be paid by the purchaser to the seller of that bond. Look at the investors who purchased the high coupon bonds in year 2024. The IFBs that were selling at 17.9 over 16%. Today, the market interest rate has gone low as 10% for 365-day Treasury bill, which is the instrument that we use to determine the market interest rate. Considering that change and looking at the new bonds that are now being floated, which are of a return, like if we look at the May auction, the highest is at 13.9% and a 14.1%, comparing with the high coupon bonds in 2024, which are still in the secondary market and trading. Such high coupon bonds have increased in value such that if the investors in those bonds were to sell them, they will get a huge capital gain which they can use to purchase the newer lower coupon bonds, but in a higher volume, generating higher returns than the return that they are getting in the higher coupon bonds. The fifth importance that I have elected we look at out of the many importance that we can highlight about bond investment or government security investing is low risk. Risk exposure is one of the most important factors that we consider in investing. Risk measure the extent or the ease with which or the probability, the chance of losing your capital, leave alone the expected returns. Government securities, which are also called treasury bills and treasury bonds or treasury instruments, they carry the lowest form of risk exposures. So for risk averse investors, bond investing is the safest mode of investment one can make. To close on the importance or why you should buy or you should invest in a bond, it's good now we highlight the fact that bonds are borrowing instruments that are issued by a government to borrow from its citizens. Citizens form what we categorize as a domestic market. When the government issues securities to borrow from the external market or the international market, that is external borrowing. External borrowing or domestic borrowing will constitute three types of bonds. There is the bills, we have the bonds, and we have notes. Those three names are derived from the characteristics of the instrument and mainly the maturity period or the lifetime of that instrument. An instrument that is issued or a bond instrument that is issued by the government to borrow and repay or mature with a period of up to 1 year, that is 364 days, that take the name of a bill, and that's why we call those bonds treasury bills. So treasury bills are basically bonds that are of a maturity period of 1 year. Instruments that mature in more than 1 year, that category we refer to as bonds, or they retain the name of bond. Then treasury notes are used rarely, but they are still there in the market from different jurisdictions, and in most cases treasury notes take the shortest maturity period. Then where should you buy your bond investment? Should you buy your bond investment direct from the central bank or the stock exchange, that is a secondary market? We will be looking at those reasons after 3 seconds short break, so don't go away. In the meantime, give us a like to this video and engage us in the comment section. And if the video has value, don't forget to share it to another person. See you after 3 seconds short break. Welcome back and thank you for your like and comment. Where should you buy your bond? Are you going to buy your bond from the central bank, or you are going to go for your investment in the stock exchange? Comparing those two, this video we are skewing it to the importance or the reason why you should go for your bond from the central bank. The first reason, the CBK, that is the primary market. What do we mean by a primary market? A primary market is where the buyer and the seller meet. And in this case, the buyer here, who is the borrower, is the government through its agency, central bank. And the seller here, who is the lender, is you. That means that there is no middleman. There are no brokers in this exchange, meaning that you are not incurring incidental expenses in your investment. You are only going to incur the value for the investment. Number two, you are experiencing least market risks. You are also going to suffer minimal delays. If you are to go to the secondary market, that market, the activities there are reserved for brokers. You must be a licensed trader. If you want to invest in the secondary market, you are going through a broker whom will charge you a fee to access that market. On top of that, in the secondary market, it may take time before an instrument that matches the amount that you want to invest is available. That will cause a delay, and such delays is what leads to wastage of the capital that you intended to invest in most cases. On top of that, or deriving from that reason number one, of you are in the primary market, which is going to eliminate all those expenses, then we are getting reason number two, tax savings. In the primary market, you are not going to incur levies charged on those transactions. Reason number three, you benefit from the bargain by the competitive bidders. The primary market, we are investing through an auction. In this auction, the yield, the market yield, is negotiated for us, retail investors, by the experienced brokers, by the experienced fund managers who bid competitively. These investors, these large investors, the fund managers, the brokers, the banks, they are exposed to the market, and out of experience, they have the know-how on how to predict the markets, and they are investing on the behalf of many other people who have put their money in a collective fund, the collective investment schemes, be it a money market fund, be it a fixed income fund, be it a balanced fund, be it a bond fund. And for that reason, with that enablance that is giving them the ability to negotiate, that power, because they're investing huge amounts, then retail investors enjoy the yield determined out of the auction of the competitive bids. And for that reason, then a retail investor gains more in the primary market compared in the secondary market. In that view, the retail investor should invest in instruments that he or she is willing to hold that investment to term. Because once we go to the secondary market, the transactions involved in the secondary market are huge, and for retail investors handling smaller capital, their transactions are referred as odd sales or odd transactions. And that is primarily what causes the delay in the secondary market when you want to liquidate or sell your investment. Number four is low entry or low cost of capital. The minimum you require to invest in the primary bond market is 50,000 Kenya shilling. Low cost of investments. Having looked at the rationale or the reasons why you need to go for your primary market investment compared to investing through the secondary market, and we have also looked at the importance or why you should hold a bond investment, then now we look at the FXD1 2012-20, which is one of the three bonds that have been reopened in May 2025. Thank you for watching and see you in our next video.